I'm not expecting 2025 to be some banner boom year, but in order for things to get better, you have to hit bottom.
That's Dave Meyer, host of the BiggerPockets Real Estate Podcast and a market expert who can help us navigate the real estate landscape of 2025.
The fundamentals of the industry have changed pretty dramatically, and I don't think people have known what to do.
In this episode, you'll learn why there aren't that many houses available to buy.
It's a lock-in effect, which is basically that sellers are locked into their existing homes because it would be more expensive for them to move.
Which regions of the country are actually affordable?
And the most affordable region of the country is now the Midwest. Not just price growth, but rent growth.
Creative strategies that generate high returns.
Hard money lending, you can get 10, 12, 14% cash on cash returns.
And now we're going to dig into all of that and more. I really want to get into what people can expect from 2025, or at least what these two people here on this podcast think we can expect from 2025. And more importantly, what strategies that I'm going to be using, you're going to be using, that we think might work in 2025. But I want to start by talking about where we've come from. And your report, the State of the Real Estate Investor report, has become my annual reading for me. I think it's really good. And I'm going to put a link to the download so everybody can check it out. It's really, really good with lots of charts and very concise and good information. But I want to talk about this thing. I don't know if you call it this in the report, but I started in my notes, I called it the stuck era. Like we were stuck from 2022 to 24. So can you kind of paint a picture of where we've come from up to this point, like early 2025?
Yeah, I need to come up with some branding for this. Stuck era is good. I've kind of thought of it a little bit as like a come down. Like in 2020 to 2022 was just this, you could call it a melt up. It was like a party. Everything was going right. And when you juice a market as much as it got in 2020 to 2022, it's inevitably going to slow down, and there's going to have to be some reversion back to normal times. And I think that's what we've seen over the last few years. It's been very cloudy economically, a bit confusing. Rates, the fundamentals of the industry have changed pretty dramatically. And I don't think people have known what to do. And I've still been investing, and I assume you have too.
Me too,
Chad.
yes.
But it's been a little bit less obvious what makes sense in this era or in this previous period. And that's been hard for me. It's been hard for everyone. But I think as we enter 2025, we're starting to get a little bit more clarity on what's the next couple of years, maybe the next market cycle is going to look like. And to me, that's super exciting because I think it allows us as investors to start making decisions and being a little more proactive than we were able to be in the last 2 years, when there was just such a high degree of uncertainty that, especially for people who are just getting started, it signaled a lot of risk that they might not have been willing to take on.
Yeah. So we're going to have an optimistic tone in this conversation. We're going to give some proactive stuff, which I love, especially when you talk economics. Usually it's like doom and gloom. So here we go.
I've been pretty negative the last few years. Like I've still been investing, but I've tried to be very clear that things could get worse before they got better for the last couple of years. And now I still think there's some volatility, but I'd like to think that we've bottomed out for the cycle.
Well, for the record, I went back and listened to our interview from last year on 2x speed because I couldn't listen to the whole thing. But for the record, you called that, if I remember right, that we're going to have small interest rate fall. Like we'd have a little bit of a reduction in interest rate, and then also that prices would go up, which was not all what everybody was saying. There was a lot of doom and gloom a year ago. So congrats on that one. You got that one right.
Thank you. I appreciate it. I spend a lot of time looking at the data, and I think that it's easy for people on YouTube to shout out doom and gloom and cherry pick data, but I just try and be as honest as possible. I'm glad I got that one right. I'm not always right, but last year went well.
Yeah, no problem. Well, so we're going to get into 2025, why we're optimistic, but I think to set the stage for what's happening potentially this year, let's talk more specifically about that stuck era. And I think the thing that stood out to me that you talked about in the report was just the dramatic fall in volume of transactions. And I don't know, can you paint this? I'm going to, in our B-roll, we'll put up a chart that you have in the report about just comparing the volume in 2024 to the average volume compared to the past. Can you just talk about why that's such a big component of the real estate market and historically where we've been compared to right now?
Yeah, absolutely. So during the pandemic, things were going very well. Everyone wanted it on the market. People were selling their properties for massive profits. And that led in the US existing home sales, which is just not new construction, to about 6.7 million. It peaked in 2022, which is a huge number. The long-term average is about 5.25 million. So that was significantly above that. This year, we're on pace for about 3.9 million. And so that is, significantly below the long-term average, but it's even further below where we were just a couple of years ago. So the change from basically all-time highs to multi-decade lows right now sort of feels very sluggish and slow. But if you look at the data and just sort of econ 101 of it, it all makes a lot of sense. Because during the pandemic era, we had very high demand and very high supply. And when you have that in market, you have a lot of transaction volume. When both of those things fall proportionally, prices can still go up because at the end of the day, we still have more demand than more supply. But both of them dropped. And this is just sort of econ 101, but both supply and demand dropped. It kind of makes sense, right? Volume goes down. And so that's sort of where we've been. And it can be confusing that even though demand has dropped, prices are going up. What really gets impacted in this type of market is the number of transactions. And as investors, that might not be the most important thing that we talk about, but it does impact all of us. It impacts our industry a lot. Agents, property managers, loan officers, all of that get impacted. But it has also contributed just to the sentiment of stuckness because there are less than 50, it's a 50% decline in transaction volume is very significant for the industry.
Yeah, and on an individual level, like an investor looking on the MLS or looking with their realtor, I think that translates to there's just fewer options of properties to buy. Like I hear all the time when I'm coaching people, they're like, well, it's just, I looked on Zillow, I looked on the MLS, there's just nothing there. It's like, well, yeah, I mean, the inventory is way down. It's like you're going to Walmart to buy something and the shelves are half full. Like they're not there, right? It's a weird phenomenon. And it just, before we, just to explain why, you mentioned something about how the supply went down, the demand went down, and this is high level stuff. But there's this thing called the lock-in effect, which we talked about a little bit last year. Can you just go over that one, just to show people why this is a weird situation, but why it makes sense as well?
My whole philosophy or theory of the housing market comes down to affordability. How much and in the housing market, that basically means how easily can the average American afford the average priced home. And this idea of affordability has really steered the entire housing market for at least the last 4 or 5 years right now. But at the end of the pandemic, basically affordability got destroyed. Mortgage rates shot up, and this made it very difficult for people to buy a home. It priced tons of people out. And that part of the equation makes sense to most of us, right? Like it got expensive, so people don't want to buy a home. They still want to buy a home, but they're unable to buy a home. What's less intuitive about this is that low affordability also impacts people selling homes. And it's because the housing market has this sort of unique component to it where nearly 80% of folks who sell their home go on to buy another one. And so they're not just sellers, they're also buyers. And when buying conditions become so bad, like they have right now, it just dissuades people from selling in the first place because they're like, I don't want to sell and then buy back into this market. I'd rather just stay put. And so that's why we've seen this affordability impact both supply and demand. And the media has come up with this term. It makes sense, the lock-in effect, which is basically that sellers are locked into their existing homes because it would be, in almost all cases, more expensive for them to move. I've done the math on this a few times. Even to move to a smaller property, it will be more expensive. And who's going to do that? No one in their right mind is going to downsize if it's more expensive to downsize. And that's what's led to this lack of inventory. And we could talk about this more in a little bit, but I'm not sure it's getting better anytime soon.
Yeah. So the name of the game, and this is going to be a theme as we talk for the rest of this episode, is affordability. You got to look in your, not only the national market, but your local market. And maybe you could talk about this leading up to the end of 2024. This was a kind of a regional story. Like there's some markets that prices like actually went up this year and affordability wasn't quite as much of an issue versus other markets. And I mean, were there any surprises you had in terms of the regional component of the real estate market this year?
not super surprising, but I think what some people might not have guessed is that we're seeing the strongest growth in prices in affordable markets, which are often markets that get ignored or overlooked by the real estate investing community. So I've been I always joke that I'm long on the Midwest because like I just think that over time people tend to move to places and job growth and businesses move to places that are more affordable. In your region, Chad, like you've seen this over the last 2 decades, right? Like people move to the Southeast, businesses move to the Southeast because there's good tax incentives. There's a lot of reasons, but because it was a relatively affordable part of the country too, we're sort of seeing a switch where so much attention has gone to the Southeast that it's becoming relatively less affordable. Certainly not California or like the West Coast, but it's less affordable than it once was. And the most affordable region of the country is now the Midwest. And we see a lot of not just price growth, but rent growth in the Midwest, even in a year where rent growth in the Southeast was negative in a lot of places. And so this is why I just repeat the same thing over and over again, but I just think affordability like sort of runs the housing market. And so that's sort of borne out over the last year. And I think will continue to sort of be one of the driving forces.
Yeah, it's very interesting. Yeah, places like I grew up in Atlanta, Charlotte's on my radar very closely. I know a lot of people in Austin. These kind of Sunbelt markets or the big cities. I mean, affordability is, even though the price is not necessarily on a nominal level, isn't the same as California. Just compared to salaries, those have been pretty unaffordable in those markets. But one other interesting thing before we get to 2025, there was just a big story was an oversupply of multifamily housing in certain markets. And so I'm thinking Austin, I'm thinking some of the big cities. So in those areas, I mean, there was a ton of new apartments. So we talked about this in your last report last year, but could you talk about just how that played out in 2024, what effect that had on different markets where there was just an oversupply of apartment units?
Yeah, it's been this story that's sort of been unfolding for the last 3 or 4 years. But during the pandemic, there was huge demand for apartments. Developers look at that and say, we're going to build apartment buildings. And they did. We saw in 2022 one of the highest years for construction starts in that asset class. But this takes a while. It can take 2 or even 3 years to build multifamily buildings sometimes. And so just over the last year, it started in the second half of 2023. It's going to go into next year. We just see all the stuff that started getting built in 2022 starting to hit the market. And that happened at a time when inflation is sort of taking a toll on consumers and there's a little bit less demand for apartments right now. And so we just have an oversaturation of multifamily in the short run. And we can talk about this a little bit later, but this is sort of like a short-term phenomenon where we're just seeing this basically a flood, like a flash flood of apartments hitting the market, and they don't get absorbed particularly well. And when there's too many things on the market, you see landlords and multifamily operators competing for tenants. And when they have to compete, they do that by lowering prices. And so we've seen very soft or even negative rent growth in a lot of the biggest boom towns. That's sort of the confusing part about it is you see Austin, incredible population growth and economic growth over the last few years, but it got too hot and people overbuilt. And so we're seeing big corrections in prices there. You mentioned Charlotte's another one. I think Raleigh is like one of the biggest ones that have dropped off as well. And so the markets where we're seeing all this growth, we see flat rents. Whereas, you look at the Midwest, you see rent growth there because developers weren't as excited about the Midwest and there's not this supply glut that you see elsewhere.
So it's really a story of what people did, what developers did 2 or 3 years ago. Did they choose to invest in Austin, Raleigh, Charlotte, Atlanta, or they didn't choose to necessarily build as much in the Northeast, the Midwest? So in those areas, exactly, as demand has gone up a little bit, you've had the prices have been able to go up, the rent's been able to go up, whereas oversupply in those other regional cities. But the thing I heard you say that I just want to highlight is we are long-term investors, which we're going to get to in the strategy here in a second. But Austin, Texas, still like really good fundamentals, right? Long run. Yeah. So it might be an opportunity, like just a little sneak peek there. Like if you're finding places where that everybody's people panic in the short run, and this is what Warren Buffett always says, like when there's blood in the streets, that's when you want to go out and take your bucket out and buy, get a bunch of stuff, gather
Yeah.
your property. So for those of you who are in those markets, don't panic about it. You need to look for opportunities in those cases.
Yeah, exactly. I think that's exactly right. We're in this weird phenomenon where some of the markets with the best long-term fundamentals are seeing the biggest corrections.
Yep.
And if you look at Austin, like it's just booming. It's still booming, but like people got a little too excited. They built too much, and that creates these inefficiencies in the market. And that's what, as investors, we typically look for.
Yep. So let's turn our sights to the future. Like we're early in 2025, and you struck a optimistic tone for this year, cautiously optimistic,
Yeah,
as a data person would, but the cautiously optimistic says things could get a little better for the market, and also for us as real estate investors. What specifically gives you some of that optimism?
I think we're hitting the bottom in terms of, I just think things aren't going to get worse. Let's just start there. And I do think they'll get a little bit better. But like we talked about, this lack of inventory is slowing down the market. In the last couple of months, we've started to see inventory come back. And we can talk about mortgage rates, but I do think mortgage rates will come down a little bit. And as they do come down next year, I think that will free up a little bit of inventory. And we will also see some demand come back into the market. I think those things are positive for transaction volume. And so we'll start to see volume pick up a little bit. When I say things are going to get better, I'm not expecting 2025 to be some banner boom year. But I think in order for things to get better, you have to hit bottom and you have to start recovering. And I think this is sort of the start of the recovery year that I expect to take 2 or 3 years at least. I do think this is sort of a long recovery, not something that's going to just bounce back up quickly, because I don't think mortgage rates are going to drop all that much. I know a lot of people do think that, but that's sort of my basic premise. And then when you talk about just like for investors, I think the long-term fundamentals of this industry are still excellent. You know, there's still demographic tailwinds. There are literally tens of millions of millennial households who want houses but just can't afford it. And so if affordability gets back, there's going to be demand. Even after, once this glut of multifamily supply is absorbed, there is still a housing shortage in the United States. We basically just we need to build more. We just don't want it all coming to market the same month, which is exactly what happened. So we still need to be moving more. I think the other thing that is, a weird thing for our society that we need to, I think, is sort of an existential thing, but housing affordability in my mind is not going to get all that much better. And I think the sort of dream of home ownership for a lot of people might not be there in the next couple of years. And so I think more families, more people are going to have to rent. And that creates demand for rental properties. And so I think all of those things sort of bode well long-term for real estate, even if this year is just sort of the beginning of that recovery.
Yeah, I want to sort of tease out the fundamentals of real estate investing, sort of the real estate 101 lesson out of what you just said, that long run, we are looking for markets, for properties, for little micro markets that have demand, that people want to live there. They have good jobs, they can pay. And then if you own a rental property, you have tenants who stay there as long as possible, who can afford increasing rents over time. So we need people who have jobs, who make good jobs. We need places where there's a lot of people wanting to move there. So what you're saying is, like, fundamentals wise, the overall economy and some of these regional markets around the country still look like fundamentally really good, which for us as real estate investors, we sort of tag along with the overall economy, local economy, right? That's exactly what I'm reading. But then from the short run, it seems like, correct me if I'm wrong on oversimplifying this, but the whole the stuck era seemed like a story of interest rates, because interest rates went up dramatically compared to what they were. That locked in a lot of people who didn't want to sell. That made it unaffordable for people to buy. And what I'm hearing you say is, even if we have a slight reduction in mortgage rates, we're nothing dramatic here, but even if it went from 6.5 or 6.75 to 5.75, that would be that would unlock a number of people. And is that sort of the simplified story of what we're seeing here?
Yeah, exactly. I think that's what we're going to start to see, that we'll start to see some improvement in affordability. Affordability can be impacted by a lot of things, right? So home prices going down would improve affordability. I don't think that's going to happen. I think they're going to be closer to, modest growth, which is what's normal. You can do it from mortgage rates, which I do think will come down a little bit next year. And then also real wages. Wages are going up in the United States above the pace of inflation. That was not true during the pandemic, but we're now starting to see wages go up. So that increases spending power. We don't know exactly what President-elect Trump is going to do, but he has proposed a couple of stimulative policies that might increase spending power for people, which could increase demand and affordability. If, for example, if you cut taxes, you don't need wages to go up if your take-home pay increases, and so that could improve affordability too. So my theory is that over the next couple of years, we're going to see affordability improve slowly from a combination of these things. It might be, long-term mortgage rates coming down, wages going up, and home price growth moderating. It's hard for affordability to improve when home prices are going up 15% a year. But if they're going up 3 or 4% a year, like that is a market where if they stay like somewhat, that's still above the pace of inflation. So as investors, I'm still happy with 3 to 4% in appreciation. But it does allow you to sort of like time to catch up and affordability to improve. And this is a whole other topic, but like I personally have a really hard time seeing affordability going back to like where we were in 2019 or years prior to that.
So this is what you call it in the report, the new era of real estate investing. And I'm going to paint the other picture. If you have a conversation with a group of investors, some people are like, well, I'm just going to wait until the prices crash. I'm just going to wait. And so what we're saying here, I mean, everybody's got to make their choice on what they think is going to happen. We're all like having a bet on the future here. But if you're going to sit there and wait on house prices to fall by 20% so that you can get in, you might be waiting for a while, right? I think that's one thing I'm hearing you say, and I 100% agree with.
In the last 100 years, it's happened once. So it doesn't happen very often. And we can get into all the data and credit scores and quality conversations about it, but it's very unlikely to happen. And I wouldn't bet on it. I think certain markets will come down a little bit, but seeing like a wholesale decline in home price values, there's no evidence of it. It could happen, of course. Like I'm a data analyst. There's always a small chance that something can happen, but nothing suggests that it is likely right now. So I wouldn't bet on it. And I was talking to someone the other day, Chad, and I keep thinking about this. Like real estate investors have this kind of funny mentality about returns where they're like, okay, returns weren't as great as they were 3 years ago, so I'm just going to wait. Can you imagine if stock investors said that? Like just in the last 12 years, 2013 was the best year for the stock exchange. We had a 30% increase in the S&P 500. Amazing. Do you think stock investors are saying, oh, I'm not going to invest this year because it's just a 10% return instead of a 30% return? If you had done that, you would have missed out on 141% returns in the stock market. Same thing is true in real estate. Even if it's not this like incredible party like was going on during COVID, I still think real estate is better than any other asset class that you could choose. And that's really how you have to think about it. You have to compare your decisions against what else you could be doing with your money right now. And waiting, I don't know. I don't think it's a very good idea. I'd rather get my good returns in real estate than wait and see if maybe spectacular returns come back.
100%. Yeah. I think it's just a different mentality. And I've become convinced we'll start here with a meta kind of conversation and get into some strategy too, specific strategies. But I've just become convinced as an investor. My big strategy is that in the United States and probably other countries too, the destiny of the economy is very closely tied to housing.
Mm-hmm. Yes.
And we had this huge mortgage market and financial market, which if you study the history of it, I mean, it wasn't there until the 1940s, 30s. It was when we started having these 30-year mortgages and this big, secondary market. But it has become like the political topic. Like if housing doing well and having the mortgage market be healthy. I mean, this is like for national politicians, for local politicians, housing. I mean, housing is tied to the economy. It's tied to people's wealth. So it is
sentiment too. It's
sentiment,
not just dollars and cents. Like people care about the housing market, even if you're not even a homeowner. It's in the it matters to consumer and just citizen sentiment in the U.S.
Exactly. And particularly with the residential market, which is interesting comparing it to the commercial market, we have a
Yeah,
ton
no
of
one
these
cares.
30-year more. Yeah. I mean, people, do I care if the developers go out of business? No, like,
Yeah.
but we have these 30-year mortgages with mom and pop homeowners who, they have these 30-year mortgages, and it's much more difficult to have a 2008-9 situation when people can just ride it out. It's like you can
Yep.
ride out a storm. We have a healthy 30-year mortgage market in the residential world, which doesn't, from my read of it, it doesn't allow you to have these like crazy ups and downs. Like in 2008, we had tons of adjustable rate mortgages. We had like big balloons on residential mortgages, which we pretty much done away with a lot of those. Whereas
Yep.
in the commercial world right now, that's happening. Like there's people having their balloon mortgages come due, and that's why there's a lot of chaos there. The residential market, in my mind, is just a very stable thing, both up and down. I mean,
Yep.
there's going to be some ups, but that's a positive, fertile soil, I think, to build on. And then we could talk about the specific strategy. How do you make money in that environment? But that, the crash versus the stable long term vehicle is kind of my main perspective that I have.
I couldn't agree more. You look at residential housing over the last 100 years, and it's incredibly stable. There's like basically two periods where home prices have gone down in nominal, non-inflation adjusted terms. It's like early in the early 90s, and that was like for 3 quarters. It's like very quick, and in 2008. And so housing, if you just want to compare it to other asset classes, is incredibly stable. You're not going to have these huge upswings all the time like what we saw in the early 2020s. But if you're building wealth over the long term, which is what real estate is for, then it is the perfect asset class for this. And thinking that prices are going to crash is wishful thinking. I don't. It's not like something, in my opinion, that's supported by evidence. And so I'm going to base my personal strategies around the long-term stability of the housing market. Like you said, there are a lot of financial, national level reasons why the market is stable. And to be honest, like the markets have learned, the banks have learned a lot about how to keep people in homes. We saw this during the pandemic. Like people thought, oh, everyone's going to lose their house. Foreclosure rates were nothing. And yeah, there were some laws around that. But even since those laws got lifted, for mortgage delinquency rates are like the lowest they've been in decades. Like people are able to pay their mortgages. And that's the only thing really that can upset the housing market. If people stop paying their mortgages, then we need to be a little bit worried about prices going down. But there is no evidence that that has happened, even during inflation, even during the slowdown, even during a couple of quarters of a GDP decline. Like people are paying their mortgages. That bodes well for housing price stability.
So given this sort of background of stability, but given this slight, increase in affordability and maybe a little improvement in the volume of the market, let's talk about some strategies that both you and I just kind of brainstorm some ideas that you mentioned in the report, and I have some ideas on too. One of those is just having a patient perspective when you buy real estate. This was
Yeah.
hard. Like being patient is hard for me personally. I'm not always a patient person, but patience is so talk about patience and why that, how we apply that as a strategy.
I just think that, particularly in this type of market, patience makes a lot of sense, and being opportunistic. I say this because the way I describe the market, I try and come up with like a word for it every year. And this year I call it transitionary. And in these types of transitionary markets, there's a lot of garbage deals, but there's also a lot of like hidden gems because there's just a lot of confusion about which way the market is heading. There's a little bit of impatience on the part of sellers because maybe they haven't had enough demand or they're not getting what they were expecting. And you might be able to negotiate with people a little bit more, but it's not sort of the era wherein, if you were in early 2020, you could have gone and bought anything. It actually benefited you to be impatient in 2020 because you had to be super aggressive in bidding. And, you had to give up terms on your contracts and to get properties. And so impatience actually worked well. I think we're sort of in the opposite era where like more patient approach, being opportunistic, being willing to walk away from deals and being very strict about what you're willing to buy is again prudent, and that is the normal state of affair in my mind for real estate investing. That's how it should be. And I for me, I only buy a handful of properties a year, so I can do this. And I think that's true for most people.
Yeah.
Is if you're only buying 1 or 2 properties, even 5 properties in a year, you could be pretty patient.
Yeah, 100%. And I'll explain how my thought on that too. When you go out to your acquisition strategy, when you buy properties, you should be the patient one, and you should look for impatient sellers.
Exactly. Yeah. Well
Another
said.
way to say
Yes.
it, motivated. You're looking for
Yeah.
motivated sellers. You're looking for people who have either a life thing that happened that makes them, they just can't afford to be patient, or they're just like itchy and they just want to sell. Like who we're looking for. And from a numbers, like a financial standpoint, I'm looking for what we talked about earlier. I'm looking for locations that have a rich potential for growth over the long run. I want demographic trends. I want cities and regions where the demographics look really good. And I have a metaphor for this that I've been using a lot on my show, that I'm looking for it's like a solar system. I'm looking for an economic sun, like Atlanta, where I grew up, you have this really hot economic sun with lots of jobs and lots of growth, and lots of potential. It's easy to recognize economic suns. You don't have to be a genius to do that. And then I look for satellite cities. Like I'm looking for the earth going around the sun, not necessarily the center of the sun. I'm looking for Noonan, Georgia, where I grew up, which has its own little gravity, its own walkability, its own town center, but it benefits from the heat of that sun. And so like that metaphor that's a fundamental that has nothing to do with the economy, like the national up and down of the economy. It has to do with the local regional economy. And then within that, to be patient there, I'm looking for value in that location. So it might be that the property that's worth 300,000 that I could buy for 250. And it might be a duplex that is worth 250, and I can make okay cash flow today, but I can see some way to add value to that property. Yeah. Maybe I can convert a second unit to a third unit. I can, has a basement that could be an apartment, or you can add an ADU in the backyard. So like, number one is the satellite city in a good solar system. Number two is finding some kind of opportunistic way to add a little bit of value, either through buying it at a discount or doing something to the property. If you combine like a really good market that has good long-term potential with a little bit of entrepreneurship, that translates to a good return on investment, as long as the market's stable, which is what our whole thesis was in the first place.
Yep, exactly. I think that makes total sense. And yeah, it's not. That's what I love about this industry. It's not rocket science. Like you put it very well, but this is a proven business model. Like, find a place where you're going to get some tailwinds. You're not going to be fighting against demographic trends. You're going to be sort of a raise all ships kind of mentality, and then do a little bit of work. If you do that, you're going to be doing just fine in this industry. That hasn't changed at all. Nothing about current market dynamics is really, I don't know, ever going to impact that. I think people sort of obsess about these short-term prices of homes, when if you're on a 10-year, 15 time horizon, it doesn't even matter what happens next year.
Yeah. And one other thing that has changed that I think people get stuck on, that I've been talking to, is they listen to everything I just said, and they say, yeah, but if I put 20% down, it doesn't cash flow. Mm-hmm. And I said, well, that was normal 5 years ago, but maybe you have to put 30% down, or maybe you have to buy at a bigger discount, or maybe you have to get seller financing. So the financing, yes, has made it more challenging. But if you go in with the premise of, this is how I'm going to make money over the long run, I'm patient, I'm buying in a good location, then maybe you have to save up a little bit more money. Maybe you have to partner with somebody else who has extra cash so you can buy the property together. So like, I say all that to say, I'm not discounting that obstacle. There are definitely obstacles today. But once you know the way you're going to make money, you can then solve for that and figure out that's what the creative investors are doing today. They're figuring out ways to solve the challenges, but they have optimism that it's going to be a good market. Otherwise they wouldn't buy in the first place.
Yeah, exactly. And I do have optimism. I think if it is more challenging right now, but I think there is a good case for long-term rent growth to be strong, to stay strong. So if you buy now, fixed debt, and even if you fix it at a higher rate, I think your cash flow is going to go up a lot. And if you're investing for that 15-year time horizon, 10-year time horizon, like, you're going to be looking pretty good in the next couple of years, even if it isn't as attractive on day one as it was, 10 years ago.
Yep. So I think for you and me and a lot of people listening, buy and hold rental properties, like we just talked about, that's probably the core business we're in. But I want to talk about two other niches that might be pretty interesting in 2025 for a lot of people. One is actually doing lending. like
Yeah.
owning notes instead of rentals, or in addition to rentals. And the other is new construction, which I'm dabbling in a little bit too.
Oh,
Can you talk a
okay.
little bit about why you like lending as a kind of a complement to rental properties?
Yeah, I have just always been sort of interested in this, because people always say it's like such a good cash business. And over the last couple of years, when cash flow has been harder to find, I've wanted to just sort of diversify my own portfolio. I still buy rental properties, and I put most of my real estate portfolio still in long-term rental properties. But hard money lending, you can get 10, 12, 14% cash on cash returns. And so that's pretty attractive. It's a very different business than owning rental properties. But I think for people who really want to prioritize cash flow and passivity, it can be a really good complement because you do diligence upfront to vet an operator, to vet a property. If you're buying a note, which is just basically buying a loan. You are being a lender in most situations to either a developer or a flipper. And because that's a hard money loan, you can charge higher rates. And there's definitely risk in that. But once you vet those things, presuming the project goes well, it's very passive. You can pay someone or hire some software to do your loan servicing. You collect interest payments every month, and then you get all your money back at the end. And so I encourage people who are looking for cash flow to consider the business of lending as well.
Yep. Yeah, I realize I haven't talked enough about lending and the cousin of lending, which is selling properties with owner financing, which I've done a lot of as well. So I think they're kind of complementary. And I haven't talked about it enough because it's actually how my business partner and I have become financially independent. Like we had rental properties, which are kind of a slow burn. I compare it to like you plant an apple seed and it takes 10 years for your apple tree to actually make fruit. That's what a rental property is to me. It's a wonderful long-term investment, but it's not that good in the first 5 years. Like you are feeding that apple tree
Yep.
and watering it. But then if you complement that with some loans and some lending and some financing, it can get you that cash flow that you want in the short term. And the other thing that I would say about lending is there is risk to it and it is a little bit different business model. But the reason it's complementary to rental properties because the worst case scenario of a lender is that you have to take the property back.
Yep.
And so if you're a real estate person, that's not something that should scare you. You should only make loan. My rule when I make a loan is I'll only make a loan on a property and at a price that I'd be excited to
Yep.
take that property back. I don't want to take it back. I'd rather get the interest, but if
Yeah.
I have to, then I'm fine with that. And the opposite, if you're somebody who makes a loan to somebody and you're afraid to take the property back, you're done. Like you are in
Yeah.
trouble because
Exactly.
you're not okay being a real estate investor.
Yeah, and I personally would only lend to people I think there's a very low chance of these things coming back. Some people are willing to do, they call it like the loan to own strategy where you're like
Mm,
giving out like risky loans. I find that a little
yeah.
amoral, but
Yeah.
I think that what you like you said, like you want people who are going to pay off the loan. That's the business. You're not like, I don't think you want to try and take these properties back. But if you do, and you're a real estate person, the risk is actually relatively low. Because just think about it. You know, me as a lender, if I lend at a 80% LTV and I have to take the property back, I'm basically getting the property for 20% off, right? Because they're already putting 20% down. And so I'm paying 80% of what the original operator was paying for that loan. And now I have to go finish the rehab and sell it off. But you are getting a discount on that. It's a pain in the butt, but
Yeah.
it does offer you recourse if things go bad. That's not the business model, but it does
Right.
prevent a total loss. And I will say that like the thing that sort of clicked in my mind about this was that, when you do seller financing or as a property owner, like I would hate evictions. It's terrible. No one wants to do this. With a private money loan, there's no one living in the house. So if you have to go take back the property, it's actually like not as complicated of a process because it's a vacant home. And there's not this like complicated set of procedures that you need to do. So you can do it relatively quickly.
Yep. Yeah, just something for some people to think about. We can have other shows on this in the future, but this is definitely a strategy that I am actively doing. It's not my main thing, but Dave and I are both doing this on our own in our
Yeah.
personal portfolio. One other strategy, which you mentioned in the report, which has been kind of one of my core focuses on rental properties, is building to rent, is actually
Yes.
building new construction or partnering with a builder. In my case, I'm partnering with somebody to build from the ground up. So you have a land, you have lots, whatever, and then you build a property. But instead of flipping the property like a lot of builders do, we either, in my case, we have 5 properties we're building, and we're going to keep 2 of them as rentals, and then we're going to sell 3 of them to sort of
Nice.
liquidate some of the lots. And so I don't know. I think that I'd love to hear your perspective on new construction as a small investor strategy and why that might be opportunistic in 2025.
So yeah, I put in my report new construction. I think there's 2 different opportunities. What you're talking about build to rent, I think is great. I've never done it, so I can't speak to that as much, but just looking at the math of it, it does make a lot of sense if you can find a good developer to partner with. I actually think new construction makes sense in that way and in another way, which is buying new construction properties, which I never would have said, in previous eras of real estate investing. But just the way market dynamics are working, first of all, it's pretty crazy. But the median home price for a new home in the US is now less than a median home price for an existing home. It's like the
Wow.
first time it's happened. So that's pretty crazy. That's not in all markets, but on a national level, that is true. The second thing is the way builders' business models work is they just have to sell things quickly. And so in these kinds of stuck markets, they often offer pretty big incentives for people to buy. This often takes the form of these days of rate buy down. So you can get like a 3-2-1 rate buy down. You can get they maybe buy you points on your mortgage to permanently buy down your rate. And that can make things more attractive. Like you might not, your top line price might not go down because builders don't like lowering their own comps. But the amount you actually pay at the end of the day and what your monthly payments come out to be could decline. And that is to buy a property that presumably is in good shape and is going to be very little headache. So this is for really long-term investors. Like new construction may not always cash flow, but like for a house hacker, for example, I think new construction to buy is like a really interesting option right now. A low maintenance, low rate for a brand new home. If you're intending to hold it for a long time, it can make sense.
100%. Yeah. And I know some investors who did that not only as a house hack, but they actually just did it as a rental property strategy where they negotiated with the builder. The builder bought their rate down from like 7 to 5.2 or something like that. So they had a 5.2% 30-year rate. And then they put a big down payment. So they were a patient investor. They had a full-time job. They put 35% down so that the cash flow would still make sense. But again, this is a patient investor strategy because they studied the location, they like the neighborhood, they like the general market, they have a rate that allows them to cash flow it today, and then they're just going to hold it over time without all the maintenance of like these really old properties. And so it's that the longer I've been a rental investor, the more I've seen how much of a hassle and a risk it is to have properties where you have big capex and you have a lot of things breaking. So I'm not getting rid of my old properties, but I am definitely mixing in. I'm trying to age out some of my properties. So I have a set of new properties, a set of old properties for different reasons, and just diversify a little bit into newer construction stuff.
Yeah, that makes a lot of sense. I think it's just something to consider. I think it's going to be very regional, market specific, if this makes sense to you. But if you're in one of those high demand markets that are seeing a correction and there's a lot of building and people are going to be struggling to move those properties, but the fundamentals of that neighborhood are good, that to me is an interesting buy opportunity.
Yep, 100%. Well, this has been really interesting. I'm going to try to summarize my thoughts here. We've been through the stuck era where things are just not moving. We're not seeing like dramatic changes there, but we might start seeing a little bit of thawing, a little bit of activity if interest rates kind of inch their way down. And there's opportunistic places where we as investors can find ways to be patient, but still buy in good locations, still find little niches of lending, new construction, other buying, doing value add to still do deals and have a good long-term perspective. Is there anything that we haven't asked that you think would be good for people to think about as with your report with the state of 2025 for real estate?
No, I think it's a great summary. I'll just underscore something we talked a little bit about earlier, but I just encourage people who are feeling stuck in this market or questioning whether it's a good time to get in to just ask yourself what else you're going to do with your money. Because real estate offers a very good, stable return. And when I look around the economy, I don't see other opportunities for that. And when it comes down to the question of should I do nothing or invest in real estate, to me, investing in real estate makes the most sense. And that's genuinely what I do. I think you and I both put our money where our mouth is in these types of things. And I just encourage you to think about that. And if the answer is no, and you see other opportunities that are better than real estate, go do that. But for me, I think that this is just a useful framing because people love to compare how the market is today versus how it was yesterday. But that doesn't really matter. It's what are you going to do with your money today that's going to move you forward, move you closer to financial independence. And to me, the answer is real estate. I do invest in other things, but it's predominantly real estate.
Yeah. Well said. I'm on the same page. Well, thank you for the report. The report is called The State of Real Estate Investing for 2025. You can find it on BiggerPockets. I'll have a link to it in the podcast and the YouTube description below. Check it out, read it, let Dave know what you think about it. I know he'd love to get your feedback.
Yeah.
And Dave, if they want to reach out to you, connect with you, you are a really busy guy. You've got, for the last time we talked, you not only have the podcast, the On the Market podcast, which I think is one of the best real estate investing podcasts anybody should be listening to. That's how I keep up to date with my market trends, but you're also back on the real estate podcast on BiggerPockets as well. So where should people hang out with you, connect with you after the show?
Definitely. Yeah. You can always find me on BiggerPockets. I am on there. You can DM me there or on Instagram where I'm at the Data Deli. I'm pretty active there too.
Great. Well, thanks for your time, Dave. Good talking to you.
Thanks, Chad.
In this episode, Dave explained how to adapt your real estate strategy to 2025. You might be wondering, how do you actually analyze deals or run the numbers in this new market environment? So in my next episode, I show you a new framework for analyzing investments, even with higher interest rates and higher prices. If you're watching on YouTube, you can click on the thumbnail above me here, or you can click on the link in the podcast or the YouTube description below. I'll see you in the next episode.